Hello everyone, and welcome back to the Web3 Daily. Today, the market has been nothing short of a bloodbath. Under the shock of suddenly escalating trade tensions between the US and China, market panic ignited in an instant, directly triggering a historic liquidation event in the crypto market. Both Bitcoin and Ethereum prices plummeted, leaving a sea of red across the board as trading volume exploded. Over 1.6 million traders were liquidated in this crash, with the total amount exceeding $19 billion. This once again highlights that, in the face of immense macroeconomic uncertainty, crypto assets remain a high-risk category. The market sentiment index has now dropped to 35, indicating extreme fear. The storm that hit the market today was ignited, you could say, by just a few words from one man. Former US President Trump announced on his social media platform that he plans to impose a 100% punitive tariff on all critical software and goods from China. The moment that news dropped, global financial markets took a nosedive, and our crypto world, being one of the riskiest markets out there, became ground zero for an epic liquidation event. I was floored when I saw the numbers. In just 24 hours, total contract liquidations across the network exceeded $19 billion, being called the largest liquidation event in crypto history. At the peak of the panic, over $7 billion in positions were wiped out in a single hour. More than 1.6 million traders lost everything on this one day. The price of Bitcoin plummeted from a high of over $122,000, dropping like a waterfall to a low of around $102,000. Ethereum and other major altcoins got hit even harder. ETH was down over 20% at one point, and coins like XRP and Dogecoin saw drops exceeding 30%. But let's be real, Trump's remarks were just the straw that broke the camel's back. The real powder keg was the ridiculously high leverage in the market. Before the crash, sentiment was overwhelmingly optimistic, and too many people had opened highly leveraged long positions. When the macro black swan event hit, the initial price dip triggered the first wave of forced liquidations from high leverage positions. These sell-offs pushed prices down further, creating a domino effect that led to a massive, vicious stampede of liquidations. This whole incident taught everyone in our circle a lesson. First, stop blindly believing in the digital gold narrative, at least for now. In the face of real global macroeconomic risk, Bitcoin is highly correlated with tech stocks and remains a high-risk asset, not a safe haven. Second, it's really hard to simply label Trump as bullish or bearish. He previously pushed Bitcoin to new highs by allowing crypto in retirement plans, but now his trade war policies have made him the biggest bear in the market. This shows we need to pay more attention to the overall macro volatility that political figures bring, rather than just their specific comments about the industry. Finally, and this might sound harsh, this epic deleveraging event, in a way, might have been a necessary cleanse. It squeezed out the speculative bubble fueled by borrowed money and eliminated the over-leveraged players. This could be clearing the path for the next, healthier, and more sustainable bull run. So, this feels more like a correction than the end of the bull market. Of course, the market is risky, and you should always invest with caution, especially in times of such high volatility. Alright, after that heart-pounding market talk, let's dive into some major news that could shape the future of our entire industry. The US Securities and Exchange Commission, the SEC, has a new chairman, Paul Atkins, and he just made a huge move, announcing the launch of a plan called Project Crypto. When I saw this news, my first thought was, the winds are seriously changing. This signals a major shift in America's regulatory approach to our industry, moving away from the old regulate by enforcement adversarial stance to a clearer, more innovation-friendly direction. This is no small thing. It could fundamentally reshape the global Web3 landscape. So what's this Project Crypto all about? Simply put, it aims to solve the regulatory uncertainty that has been a constant headache for our industry. First, they want to establish bright-line rules for the issuance, custody, and trading of crypto assets. This means we'll finally have clarity on whether a coin is a security, a commodity, or a stablecoin, so no more guesswork. Second, they're proposing a regulatory framework for super apps, which means compliant platforms could offer both security and non-security digital asset services under a single license. Imagine how much that would cut down on compliance costs. More importantly, the plan explicitly states it will create space for DeFi and on-chain automated systems to grow, and it emphasizes that protecting the right of American citizens to self-custody their digital assets is a core American value. When I saw that part, I felt like they finally get it. Lastly, they're considering an innovation exemption to allow new business models and technologies to enter the market faster. Basically, the US is trying to lure back all the Web3 companies' talent and capital that fled over the past few years due to regulatory ambiguity. They want to become the crypto capital of the world. If this framework is actually implemented, the impact will be massive. It won't just attract projects and developers back. More importantly, a clear and stable US regulatory environment is the key to unlocking large-scale institutional capital. This would significantly accelerate the maturation of our entire industry. And I think this shift is more than just policy. It's a change in philosophy. The SEC chairman even joked that they are the Securities and Innovation Commission. The signal that sends is powerful. It means regulation should adapt to new technology, not force new tech into old boxes. If the SEC can truly transform from adversary into a partner, it would be an incredible tailwind for the long-term health of the industry. Just as we finished talking about the good news on the regulatory front, a blunder that's both hilarious and alarming happened, sounding a major warning for the entire industry. The stablecoin issuer Paxos, the company behind PayPal's stablecoin PYUSD, had a major slip-up recently. They minted a whopping $300 trillion worth of PYUSD on Ethereum. You heard that right? 300 trillion, a figure more than double the combined GDP of every country on Earth. Fortunately, they reacted quickly. They discovered this colossal error within about half an hour and promptly burned all the tokens. The official explanation was an internal technical error and a user input mistake. But even that brief half hour was enough to send a cold shiver down the market's spine. The DeFi lending giant Aave immediately announced it was temporarily freezing its PYUSD markets, fearing potential chaos. So what's the most profound takeaway from this? It completely exposes the centralized Achilles heel behind the so-called decentralized finance. We talk about decentralization all day long, but the central banks of the DeFi ecosystem, these stablecoin issuers, actually hold an astonishing amount of power. A single company's internal operational error can in an instant create a money supply large enough to disrupt the global economy. This reveals a critical single point of failure. In essence, this incident was a gift to regulators worldwide. There's no doubt that scrutiny and regulation of stablecoin issuers will become much stricter in the future. For our next story, let's shift our focus to the global chessboard of crypto exchanges, with Binance as the main player. After a tug-of-war that lasted over 2 years, Binance's grand plan to acquire the South Korean exchange, Gopax, is finally about to come to fruition. South Korea's Financial Intelligence Unit, the FIU, recently approved Gopax's executive changes, which is basically a green light for the acquisition. This means that after exiting the Korean market in 2021, Binance is finally making a comeback. The journey of this deal has been incredibly bumpy. When Binance first moved to acquire Gopax, it was more like a rescue mission. At the time, Gopax was on the verge of collapse because its DeFi partner, Genesis, went bankrupt, freezing tens of millions of dollars in user funds in its wealth management product. And Binance stepped in to save the day. However, Korean regulators kept the deal on hold, mainly due to concerns about Binance's anti-money laundering risks, especially since Binance was in deep trouble with the Department of Justice and the SEC in the US at the time. So why the approval now? The turning point was Binance's recent settlement with US authorities, where they paid that massive $4.3 billion fine. Once that check was cashed, it effectively closed the chapter on their compliance issues in the US, and the Korean regulators' concerns were eased. So, if you think about it, Binance essentially used the colossal fine as a strategic cost to buy a long-term ticket into a high-value market like South Korea. This is a lesson for all crypto companies with global ambitions. Sort things out with the top player, the US, and the doors to other markets will open for you. And the Korean market is crucial for Binance. Gopax holds one of only 5 fiat to crypto licenses in the country. Securing it means getting a ticket to compete at the highest level in the Korean market. The next piece of news, I believe, could completely change how we value the old-school mining sector. While exchanges are still fighting for global territory, another war over computing power has already begun. A group of tech and finance giants, including BlackRock, Nvidia, Microsoft, and even Elon Musk's XAI, have teamed up and dropped a staggering $40 billion to acquire a major global data center operator. What's their goal? It's simple: to secure computing resources for the explosive growth of artificial intelligence. Now, here's the crucial part. What does this have to do with us in the crypto world? Everything. Because this acquisition has inadvertently revealed just how undervalued mining companies are. According to analysis, this deal values data center power capacity at roughly $8 million per megawatt. And how does the capital market currently value Bitcoin miners? About $3 million per megawatt. Do the math on that difference. It's a premium of a whopping 160%. In other words, the AI giants are telling the market with cold hard cash, those facilities and power infrastructure you miners have are far more valuable than you think. So this gives us a completely new perspective. The core asset of a mining company may no longer be just their mining rigs or how much Bitcoin they hold. It's the core competency they've built up over the years in energy procurement, infrastructure, construction, and high-density power management. These are the exact capabilities that AI data centers are desperately seeking right now. Therefore, miners are no longer just the Bitcoin producers. They are transforming into high-value energy and computing infrastructure providers. Some analysts are even predicting that miners who successfully pivot to providing services for AI clients could see their valuations re-rated by 150 to 500%. This could be a historic fusion of the two biggest trends of our time: artificial intelligence and decentralized computing. If the BlackRock and Nvidia deal painted a grand blueprint for the fusion of AI and mining, then this next story is a concrete example of how that blueprint is being put into action. Bitcoin miner Bitfarms recently announced its plan to issue $300 million in convertible senior notes. The official announcement was very formal, stating the funds are for general corporate purposes. But at this particular moment, everyone in the industry knows what that really means. It's highly likely they're raising money for expansion, specifically to pivot towards the high-profit sectors of high-performance computing and artificial intelligence, HPC, and AI. This is especially true after the Bitcoin halving, as mining profits are being squeezed and miners are actively seeking new paths. Bitfarms isn't the first to do this. Recently, major miners like Cypher Mining and TeraWolf have also raised significant funds in similar ways, showing that the capital markets are buying into this transformation story. So you see, the macro trend, the high valuation of computing infrastructure driven by AI and the micro-level corporate actions, miners raising capital to build these facilities are perfectly aligned. The story of miners transforming is becoming a reality step by step. Finally, just as we were discussing the long-term positive trend of miners transforming, a bombshell dropped that dragged us all back to a harsh reality: security. The well-known global exchange, Bybit, was hacked. Attackers exploited a vulnerability and successfully stole over 400,000 Ethereum and Stay ETF, with a total value exceeding $1.5 billion. This is arguably one of the most severe thefts in crypto history. The timing of this is just brutal. The market was already in a freefall. Everyone's panicking. And then a major exchange has a massive breach like this. It's like pouring gasoline on a fire. This immediately puts trust in the security, internal controls, and the reliability of centralized exchanges back on the hot seat. In the short term, this is a strong bearish signal. No question. It could scare off new capital and even trigger a wave of withdrawals from existing users. But in the long run, events like this often force the industry to evolve. First, this is probably the best advertisement hardware wallets could have ever asked for. The phrase, "not your keys, not your coins," is going to be on everyone's lips again. I predict we'll see a huge wave of people moving their assets off exchanges and into their own cold wallets. Second, you can bet the regulatory hammer is about to come down. The ghost of FTX hasn't even faded, and now we have another $1 billion plus theft. This is like handing a weapon to the regulators. Things that were just being discussed before: mandatory proof of reserves, third-party audits, insurance funds could become law very soon. Alright, that's all for today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we sift through the Web3 world to bring you the most critical information that's closest to wealth, and we hope that by breaking down these curated insights, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've prepared exclusive registration links for major exchanges in the comments section below. These are high rebate offers we've secured for our fans, and I hope they can help you save some costs on your investment path. Let's stay rational, move forward steadily, and get rich slowly together. In the world of Web3, may every one of your crypto assets grow steadily. We'll see you tomorrow.